So we're here to talk about real estate today, and we have only a little bit of time, and a lot to cover. So we'll kick off. I'm Leah Dillon. I'm Chief Operating Officer at Alliance Global Advisors. We're a female-owned consultancy helping GPs and managers in the real asset space accelerate their growth goals. Yeah. And I'm here joined by 3 veterans in the real estate industry. So I'm going to ask them to just briefly introduce themselves, their firm, and what their firm does, just to set some context for what we're going to talk about today.
So nice to be here. Thank you, Leah. So Margaret Anadu, I'm a senior partner at the Vistria group where I run real estate. It's actually a business that we launched fairly recently. Vistria has been around for about 12 years, managed $12 billion, predominantly in middle market private equity. And so real estate's a new vertical that we launched about a year ago. And prior to that, I spent 20 years at Goldman Sachs where I ran a real estate investing business focused on urban mixed use, but with a real significant focus on housing.
Thank you. And thank you guys for having me. Anar, Chudgar, I'm co-president of Artemis Real Estate Partners. We started about 15 years ago. We were the first majority female-owned real estate private equity firm in the country. Today, we are $10 billion of equity under management. We have 15 vehicles. We invest across the risk spectrum and across the capital stack, across all asset classes. Yeah, that's about
it. Good morning. I was about to say good afternoon. I've been all kinds of different time zones. So my name is Ryan Williams. I'm the founder and the CEO of Cadre. Cadre is a technology-driven real estate investment platform. We invest primarily in middle market, sort of mid-cap, multifamily, and industrial around the U.S. Generally are targeting mid-teens net IRRs. And we built a technology platform that allows us to serve both individual LPs as well as institutions. We have about $3 billion of equity under management, and we are navigating these interesting and exciting times.
Great. Thanks so much. So the title of our panel today is a little dramatic, Why the Death of Commercial Real Estate is Greatly Exaggerated. I think all of us up on this panel today thinks that is an exaggeration, but real estate has not come without its challenges, certainly over the last year and the years prior. So we wanted to just level set a little bit before we kick off the conversation. I have the pleasure, I get to sit in a very neutral space as it relates between our GPs and managers that we serve at Alliance and also our investors. And so we're able to talk to a lot of investors and consultants and hear what they're thinking and the trends they're seeing. And so some of the trends that we've heard from them is, this year they expect to put out more capital than they have in prior years. It's still tough. Partially contributing to that increase in deployment but not meeting their full allocations is the fact that they've deployed a significant amount of capital over the years prior that's still sitting but undeployed. And so that causes challenges for new managers, but also existing managers alike, because they're going to be more cautious. But that all being said, real estate allocations are staying neutral to increasing depending on the investor. So we still feel positive about that. The investor community believes in general that there's going to be a great opportunity over the next handful of years, as I think the rest of us do, and we'll hear from our panelists in a second. And there's a fear amongst some of them that they don't want to miss the opportunity that they did in the GFC, post-GFC, by not leaning in or thinking about those opportunities quickly enough. And one of the biggest questions that we're hearing from investors and consultants today, that I'll turn it over to the panelists next to answer, is where are you seeing the opportunities? Where are the green shoots in the market? And how are you building your pipelines to take advantage? And so I'd love each of the panelists to answer that question. And Margaret, we can kick off with you.
Oh, exciting. So first, I do have to comment on the title of the panel, the death of commercial real estate. I mean, Leah mentioned it's obviously purposefully dramatic, but I think it's even funny to think about the death of commercial real estate. It'd be like the death of tech. Like we're here, we're in a building, people are paying their rent, people are going to offices, people are finding somewhere to sleep in their homes. So yes, I don't think we're going to be dead just yet. So I guess I would say in terms of opportunity and where at least our team is seeing green shoots, and I'll be clear, we launched a new fund about a year ago. We are a buyer, not a seller, and we're predominantly focused in multifamily. So we're in a space that has incredible just structural tailwinds. So I would say there are a few places we're seeing opportunity. One, just in the lower segment of multifamily, so both income restricted, affordable housing, but also workforce housing that really supports folks and individuals and families in that 100% kind of median income range, where even with the rents that we've seen sort of play up since COVID and a little bit of moderation there, we still have a 7 million unit deficit nationally to really balance that supply and demand for individuals and families in that demographic. So we're seeing significant opportunity there to both acquire affordable housing, acquire workforce housing. In some cases, we're actually acquiring market rate workforce housing and actually converting it to affordable. So we're seeing a lot of opportunity there. So excited about that opportunity. I would say on the debt side, so much of the distress and dislocation we've seen over the last few years, obviously, has been because of the increase in rates and folks who, acquired assets at cap rates that made sense in a very low interest environment. We're very, very, very focused on cash flow and just the operation of these assets. And so we're doing a lot of acquisition and even development on a very, very low leverage basis. So seeing a lot of opportunity there. And I would say more broadly, away from a specific strategy, I think the opportunity is to have ideas again, to have a thesis, to have a view. I think one of the things that happened over the last cycle in real estate is there was this sort of merging of everything, right? You would buy a multifamily asset at a 4 cap in a really high growth coastal market in the same way you would a relatively tertiary market. And so I think what we're starting to see, which I think is very good, is a real differentiation and sort of not just relying on incredibly accretive capital markets conditions, but actually focusing on assets and growth and markets and projections. And I think that's going to be incredibly healthy.
Great. Thank you.
Yeah, I think we can't look at the market in a one way and say, hey, it's dead. I think that there's really fascinating things that are occurring in the market right now. So if you look at Texas, for example, there hasn't been a single multifamily trade if you take Dallas, that is greater than a 5 cap. And if you think about where's cost of debt today, cost of debt is significantly higher. But yet you see these trades of Class A multifamily, Class B multifamily, very stabilized assets that are trading at sub 5 caps. So when you look at and you think of the analysis of why is that occurring when cost of capital or cost of debt is 6.5 or 7, it's because of the different sources of capital out there. So of course, real estate's not dead. When you look at what's occurring in the office, on the office side, you see a lot of family offices taking advantage of office acquisitions. I actually read in the paper, Steph Curry bought an office building in San Francisco for his own business. So I do think that I think what we're trying to fundamentally fix in the real estate industry after 10 plus years of low interest rate environments is how do we fix the capital structures?
Yeah.
Because in general, from a real estate perspective versus the GFC, we are in great fundamentals. We didn't overbuild. We have a lot of tailwinds, and because we didn't overbuild, there's secular or structural demand for residential. You have this phenomenon. We just acquired 3 million square feet on the border in Texas because we have all this onshoring occurring, and there's more production in Mexico, and there was more spent in Mexico than it was in China over the past year on manufacturing. So when you see these demands, you see this thesis for real estate where we just have to live through the reset of cost of capital and a reset of valuations, and that is going to be difficult. But we're seeing opportunity. I just mentioned 3 million square foot portfolio we just bought. We're seeing a lot of opportunity for people who are finally coalescing and saying, I'm just going to sell my assets because I don't see this environment changing. And I actually think there's been an interesting phenomenon. The beginning of the year, most investors saw the SOFR curve and said, okay, I believe in the SOFR curve, and so interest rates are going to go down. So you saw an increase in transaction volume in the beginning of the year. But recently, with the economic data that has come out, you've actually seen that people are now believing we're going to be higher for longer, and there may not be a rate cut towards the end of the year. So you're actually seeing coalescing occurring because people are like, I can't wait yet another year. My debt is coming due. I do need to just trade these assets. And we're taking advantage of that by buying the assets. And actually, the past 3 deals we looked at in investment committee, we're buying unlevered. Because we can buy those assets without putting leverage, fix the assets, and then hopefully ride out the capital markets.
Yeah, I third the hyperbolic nature of the title. I don't think commercial real estate's dying. I think it's evolving, and I think that's exciting if you're able to capitalize on opportunities that at least we're seeing in sort of 2 swim lanes. One is capital structure driven opportunities, and the other is operational inefficiencies or operational drag opportunities. And so we're focused on the fact that in the niche we invest in, the middle market, so these are real estate transactions between 15 to call it 40 million of equity. There's more than 800 billion of debt coming due in the next 15 months. And out of that 800 billion, about 40% of that debt's held by regional banks. And we hear every day about the challenges that a lot of regional banks have and are having. And we're focused on using the data that we have at our fingertips to speak to every single local operator, about 60 in total around the country, to understand within their current portfolio, where are they stressed or worried about, the inability to refinance, where are they stressed about the inability to extend and restructure their debt, and where can we come in as not so much rescue capital, but just true equity partner capital, and whether that's preferred equity restructure or common, either entry point work for us. But I do think there's a huge opportunity if you're really micro-focused to identify some of these stressed, not distressed opportunities ahead of the maturity dates for debt. And we're seeing a ton of opportunities there, 2 we just secured in our portfolio. The second way beyond capital structure inefficiencies we're focused on sourcing is operational inefficiencies. So Margaret alluded to this, but if you just look at the cost of insurance, especially in the coastal markets, in some places, it's doubled the last 2, 3, 4 years. And so what's happening is cash flows are being compressed significantly. And that means is you've got LPs who are, as I'm sure you've heard from other panels, worried about the lack of distributions. And, some of the operators and partners we work with are ready to take some chips off the table and return some capital. So we're focusing on deals where, there's, call it 2 to 3% type net levered yields to our investors. We generally target 6 to 7%, whether that's in our existing portfolio and other assets that our operators have, and letting them know, hey, we can help you put some points on the board and generate return of capital ahead of time before you have another year of compressed dividends and distributions. So I think the market's evolving. I think, the beauty of real estate is there's always great micro opportunities, even in a challenging macro environment. And I think that the winners will be the ones that can be adaptive and flex to where the ball is going. And the cream's going to rise to the top. So I'm excited about the evolution that's happening.
Great. Could you each, just coming off of that, speak a little bit to this fear that we're hearing from investors about being able to find the pipeline, right? That they believe in the thesis and they understand the data and, talk to your researchers or your investment teams and they believe in it and want to invest in it. But with transaction volume down, although we're seeing it pick up, how have you been creative? Ryan, you touched on this a little bit, talking to all your operators. How have you been creative to try to find other avenues to source your pipeline?
You want me to go?
Or maybe any one of you that...
I'll let Margaret.
Okay.
Awesome.
Flip it.
Well, I want to pull all of this together. Like I think if you're sort of sitting, there's like sourcing and getting deals, and there's like being creative and creating opportunities. I think the last cycle of sort of, flipping through 10 broker books, putting in bids all across the board, and I'll take multifamily. Sort of the value add playbook, buy an asset in a growing market, do some pretty minor CapEx, bet that you're going to increase rents 10, 15% and sell it at a cap rate in 4 years that's 100 bips below where you bought it. Like, that is over. Like, even if you heard what both of them described, it's opportunities where you're getting in there and doing the work. So as we think about sourcing, it's not sort of how do we, get to the bar with the right brokers. It's like, what are the assets in the markets that we want to be in? And then what can we do to create value? So I'll take Dallas just because you mentioned it. So we recently bought 400 unit Class A 2016 vintage asset in Dallas. We did buy it above a 5. We did buy it above a 5 cap. Maybe that hasn't hit the data yet. But then we worked locally with the city of Dallas to basically eliminate property taxes into perpetuity in exchange for being willing to restrict a certain amount of the rents for a certain demographic. So we bought it at a good price, immediately expanded our yield 100 basis points. Like, that deal didn't just sort of, fall out of the sky. We created it. I think similarly, we're talking about, operating efficiencies and really getting in there and working assets. Well, part of the Inflation Reduction Act is this thing called the Greenhouse Gas Reduction Fund. EPA literally in the last few weeks just put out $27 billion that can be used by real estate owners to, get more efficient boilers, replace appliances, LED lighting, new roofs. So we're looking at those opportunities and using them across our portfolio. So I think it's not a question of kind of how do we find the pipeline, what does the sourcing look like? It's what are the ways that we think we can create value, and there are, even with lower transaction volume, we're certainly seeing far more opportunities and assets than we end up taking a look at. So I think it's about how you really get in there and create value is how I think about it.
Yeah, and I would just add too, to piggyback on what Margaret was sharing. Is that better? Okay. Yeah. I don't have to yell this way. Just to piggyback on what Margaret was saying, I think that one of the other big differences is from 08, 09 to where we are today is there's a lot more connectivity and privity between the sponsors and the operators. There's more ongoing dialogue that does seem to be a lot more constructive, which means there's more information sharing, data flow, and there's technology tools that help facilitate that, which I think allows there to be just a greater pulse on where the opportunities in the market are today, and to be solutions focused, in terms of trying to figure out how to ultimately add value. And so to the theme of this panel, I really think that, we're seeing a paradigm shift in the space for the positive, which is one that's really underpinned by partnership, and it's not so zero sum. And that's what's ultimately going to allow a lot of opportunities to surface in a way that, you didn't see when sharper elbows were out in the past.
I think this idea of creativity, both on how you can extract value, but also when you're sitting in a manager seat and you've been successful doing something one way for a very long time, that you're nimble enough and thoughtful enough to be able to adapt and evolve to meet the market, I think is going to be crucial. And I think, Ryan, I don't know if you said it, but there will be winners and there will be losers. And I think those that can remain flexible and think about the opportunities that present themselves will remain out.
Hopefully there will just be people who lose for a while.
Yes.
Not like ultimate.
Maybe that was a little
harsh.
Could you, the other thing that we hear, and I think this idea of transparency, has come up a lot over the last decade, at a minimum. And I think transparency, yes, important. But if we dig in a little bit, what did we learn through this sort of turbulent and volatile couple of years as we dug into our portfolios, kind of hunkered down with our processes, beefed up our asset management, learned more about our partners? What if you had one or two takeaways on what you learned over the last couple of years and how you maybe are adapting or evolving based on those learnings?
I mean, I can start. So I think first and foremost, and I think it comes from our pedigree of, I've been through 3 cycles. My team, some of my colleagues have been through 5 or 6 cycles. We always looked at our financing and said, okay, what happens if we can't refinance? And we've always run those scenarios. So I think one takeaway just for the industry as a whole, and if you look across the, if you look at the average age of a real estate professional, they spent most of their career in this low interest rate environment. And so it's about not always understanding that financing is not always available. And so how are you being thoughtful and being proactive on your financing, i.e. are you thinking about the fact that maturity, like we've already tackled all of our maturities across our entire firm for the whole year, for this year, and already starting to tackle some for next year. So we're being proactive in our financing strategy, and I think that's really important because, as regionals took more share of the financing of real estate in the country, they have now withdrawn their ability to finance locally, and that's caused a real dislocation in the middle market. And number 2, from an asset management perspective, you have to create value. Financial engineering does not work for real estate. And I think there's a lot of trades because of secular tailwinds, because of the institutionalization of niche asset classes, also because of just the fact that the whole market change with e-commerce and logistics. People were able to just buy assets and then trade out of them at a tighter cap rate and make a bunch of money. And I think this next cycle is going to be more akin to when I started my career, which is you're really going to have to start to show how you can really increase revenue, increase EBITDA, and make money that way.
Anyone else? I agree.
Yeah, I would just say that one key learning we've had is we got to get these mics working. One key learning that we've had is just the importance of investor and sponsor alignment. And I think there have been enough examples, some you've read about, some you will read about, where there are certain LPs or investors who don't have the same time horizons as the managers might have liquidity needs that aren't being met. And I think that goes to ensuring that, once you're going into these transactions and once you're raising a fund or closing a deal, you're upfront and transparent with your LPs about exactly what the structure entails and that this, it's a marathon, not a sprint. And so I think you're starting to finally see, just with the proliferation of more investors participating in the space, also more misalignment and alignment as well. And then again, I think, strategy creep is also something that a lot of people in the zero interest rate environment kind of fell a bit prone to that, I think will create more complexity as well. So those are maybe a little more negative leaning, but they're still learnings nonetheless.
I think it's always interesting. There's always an ebb and flow in our industry. Investors want blind pools, then they don't want blind pools, or, they want diversified, or they want sector specific. And I think, there was a moment where sector specificity had a strong hold, but the diversified, opportunities started to be allowed back in. But I think in this environment, we've seen a huge shift back to do what you do best, and we'll worry about the rest later. And so I think that's a great point. I am looking at the clock, and we are 26 seconds away from being called off the stage. But I hope you found this informative and useful. I feel honored to be up here with these great friends and industry colleagues. And some of us may be around after the panel if you have any questions, because we weren't able to take them up here. Thank you so much for your time.